Every government claims to serve the people. Every politician promises stability, prosperity, and growth. But behind the speeches, behind the campaigns, there exists another force, quieter, more technical, yet far more powerful. That force is the central bank. Central banks do not march in parades. They do not run for office. Most people cannot even name the individuals in charge. Yet these institutions decide how much money exists, who receives rescue support, which banks survive, and which banks disappear. They can make your mortgage cheaper, your savings meaningless, or your retirement fund collapse. And they can do all of this without a single vote from you. This is the hidden history of central banks. How a small number of institutions became the true power holders of the modern world. To understand how this happened, we must return to the 17th century. Europe was unstable. Wars emptied treasuries. Monarchs spent excessively. Governments were constantly short of hard currency. In England, King William III required funds to wage war against France. But lenders hesitated. The crown was known for failing to repay debts. A new institution was created with a unique privilege. It could issue notes, paper promises backed by government obligations. For the first time, money in circulation was no longer limited to metal coins, but paper supported by the credit of the state. The Bank of England became both the king creditor and the banker of the nation. The message was unmistakable. Whoever controls the flow of credit controls the state itself. Other nations followed the example. Sweden had established the Riksbank earlier in 1668, but the Bank of England became the true model. Throughout the 18th and 19th centuries, central banks spread across Europe, always connected to governments that required dependable credit to fund wars, empires, and industrial growth. By the time of the Napoleonic conflicts, the relationship between warfare and finance was undeniable. Napoleon armies advanced on credit as much as on gunpowder. Britain's ability to borrow through its central bank gave it the endurance to outlast France. The pound sterling supported by the Bank of England became the foundation of the global financial system. Wars were not decided only on battlefields. They were decided in the ledgers of central banks. Yet, the most dramatic transformation arrived in the 20th century. In the United States, the financial system had long been fragmented and unstable. Banks issued their own notes. Panics erupted whenever trust vanished. The most famous occurred in 1907, when a collapse on Wall Street spread nationwide. Banks failed depositors, panicked, and the system stood on the edge of disaster. It was not the government that restored order. It was a private banker, John Pierpont Morgan. From his residence, Morgan summoned other financiers, shut the doors, and compelled them to supply liquidity to stop the panic. One man had stabilized the American financial system more effectively than Congress. For political leaders, this was both embarrassing and frightening. The nation needed an institution that could act like Morgan but on behalf of the country. In 1913, after years of debate and secret meetings on Jekyll Island, a secluded retreat where bankers and lawmakers quietly designed the plan, Congress established the Federal Reserve System. The Fed was structured to remain separate from daily politics, yet closely connected to Wall Street. It could issue currency, set interest rates, and serve as a lender of last resort. In practice, it became the financial engine of the nation, privately influenced yet publicly authorized. Few understood how much power had just been created. The First World War became its first major test. The cost of industrial war was immense, and no nation could finance it through taxes alone. Central banks intervened. They created money-issued bonds, and kept governments functioning. The gold standard, the former anchor of money, was abandoned as nations suspended convertibility. The lesson was harsh. When governments face survival threats, central banks will always finance them. Money creation was no longer an emergency tool. It became standard policy. After the war, inflation tore through Europe. The German Reichsbank, under political pressure, printed marks until they lost all value. Weimar hyperinflation remains the most notorious case of a central bank destroying an economy. Yet even this catastrophe did not end the experiment. Instead, it confirmed that central banks were now essential, whether for stability or for collapse. The Great Depression revealed their darker influence. In the late 1920s, speculation pushed markets ever higher. When the bubble burst in 1929, the Federal Reserve failed to respond forcefully. Banks collapsed, credit froze, and millions lost employment. Economists continue to debate whether the Fed's restrictive actions worsened the downturn. But one fact became undeniable. Decisions made by a central bank can determine the fate of millions. Governments paid attention. After the Second World War, they sought to coordinate central banking on a global scale. In 1944, while the war still raged, representatives from 44 nations assembled in Bretton Woods, New Hampshire. The plan was ambitious to construct a new international financial system. The United States dollar, backed by gold, would stand at the center. Other currencies would be linked to the dollar, and institutions, such as the International Monetary Fund and the World Bank, would promote global stability. But beneath this structure was a simple reality. The United States Federal Reserve and the United States Treasury now sat at the core of the global economy. Money itself had become a geopolitical instrument. That illusion collapsed in 1971. Growing debts from the Vietnam War and expanding domestic spending placed enormous strain on American gold reserves. Foreign governments began requesting gold in exchange for their dollars. President Richard Nixon faced a decision: allow gold reserves to disappear or dismantle the system. He chose to end it. On August 15, 1971, Nixon announced that the dollar would no longer be convertible into gold. The foundation of the Bretton Woods system vanished. From that moment, the world entered the era of pure fiat money currencies, supported only by government authority and managed by central banks. The age of monetary restraint ended. Central banks now possessed unlimited flexibility. They could create money freely, and they did. Look at the crises of the past 50 years. In the 1980s, Federal Reserve Chairman Paul Volcker raised interest rates to nearly 20% to crush inflation. The outcome was a severe recession, but also a restoration of confidence in the dollar. The Fed demonstrated it could use its authority, like a blunt instrument, reshaping the economy through a single decision. In 2008, when the global financial system collapsed, central banks responded with unprecedented force. The Federal Reserve, the European Central Bank, and the Bank of Japan created trillions of dollars, euros, and yen to rescue banks and stabilize markets. They called it quantitative easing. For Wall Street, it was salvation. For everyday savers, it was erosion. Low interest rates and soaring asset prices rewarded the few while disadvantaging the many. In 2020, during the pandemic, the process accelerated dramatically. Central banks created money on a scale once unimaginable. Stimulus payments, bailouts, and corporate rescues were all financed by money created with keystrokes. The balance sheets of major central banks expanded to levels previously thought impossible. The justification remained constant stability. The cost was inflation, asset bubbles, and the quiet realization that money now exists as whatever central bankers define it to be. This is the underlying reality. Central banks are not neutral observers. They are power brokers. They decide who endures recessions and who receives rescues. They determine which institutions survive crises and which disappear. They can inflate debts away or impose deflationary pain. Their decisions reach deeper into daily life than any election. Yet they operate behind layers of complexity. Interest rates, liquidity, programs, bond purchases. The language obscures the truth. These institutions create money and direct credit on a scale no private actor could imagine. Each intervention expands their influence. Each market rescue increases dependence. Every bailout and every injection of liquidity strengthens the expectation that support will always return. The result is a global economy dependent on central bank intervention. Contradictions are growing. Governments run historic deficits, assuming central banks will suppress interest rates. Banks take extreme risks, confident intervention will arrive. Investors chase speculative bubbles, trusting that protection is guaranteed. But history shows that illusions eventually fracture. The credibility of the Bank of England weakened in the 18th century. The Reichsbank collapsed into hyperinflation. The Bretton Woods system disintegrated in 1971. Every financial structure, regardless of strength, eventually encounters a breaking point. So what does this mean for you? It means recognizing that central banks, not elected officials, manage money. When they choose to inflate wages, slowly purchasing power erodes. When they tighten policy, mortgages become more expensive. When markets are rescued, asset owners benefit while savers suffer. It means understanding that the global system depends on trust, and trust is fragile. If confidence in the dollar, the euro, or the yen disappears, central banks cannot manufacture credibility. Resilience does not come from promises made by bankers, but from assets they cannot create at will. Gold, land, skills, and productive enterprises have endured every collapse of monetary confidence. The secret history of central banks is not truly hidden. It is visible in every crisis, every rescue, and every inflationary surge. These institutions were created to serve governments. They expanded by financing wars. They grew by stabilizing crises, and today they stand at the center of a worldwide financial empire. They are not elected. They are not accountable in the way governments are. Yet their decisions shape lives more than nearly any law. This is the paradox of modern finance. The people we never vote for control the money we cannot live without. If this offered a new perspective, remember this. The answers are not hidden in the future. They are written clearly in the past.